occasional memos to my clients, first at Trust Company of the West and then at Oaktree Capital Management, the company I co-founded in 1995. I used the memos to set forth my investment philosophy, explain the workings of finance, and provide my take on recent events. Those memos form the core of this book, and you will find passages from many of them in the pages that follow, for I believe their lessons apply as well today as they did when they were written. For inclusion here, I've made some minor changes, primarily to make their message clearer. What exactly is the most important thing? In July 2003, I wrote a memo with that title that pulled together the elements I felt were essential for investment success. Hear how it began. As I meet with clients and prospects, I repeatedly hear myself say, the most important thing is X, and then 10 minutes later it's, the most important thing is Y, and then Z, and so on. All told, the memo ended up discussing 18 most important things. Since that original memo, I've made a few adjustments in the things I consider the most important, but the fundamental notion is unchanged. They're all important. Successful investing requires thoughtful attention to many separate aspects, all at the same time. Omit any one, and the result is likely to be less than satisfactory. That is why I have built this book around the idea of the most important things. Each is a brick in what I hope will be a solid wall, and none is dispensable. I didn't set out to write a manual for investing. Rather, this book is a statement of my investment philosophy. I consider it my creed, and in the course of my investing career, it has served like a religion. These are the things I believe in, the guideposts that keep me on track. The messages I deliver are the ones I consider the most lasting. I'm confident their relevance will extend beyond today. You won't find a how-to book here. There's no surefire recipe for investment success. No step-by-step instructions. No valuation formulas containing mathematical constants or fixed ratios. In fact, very few numbers. Just a way to think that might help you make good decisions, and, perhaps more important, avoid the pitfalls that ensnare so many. It's not my goal to simplify the act of investing. In fact, the thing I most want to make clear is just how complex it is. Those who try to simplify investing do their audience a great disservice. I'm going to stick to general thoughts on return, risk, and process. Anytime I discuss specific asset classes and tactics, I do so only to illustrate my points. A word about the organization of the book. I mentioned above that successful investing involves thoughtful attention to many areas simultaneously. If it were somehow possible to do so, I would discuss all of them at once. But unfortunately, the limitations of language force me to take one topic at a time. Thus, I begin with a discussion of the market environment in which investing takes place, to establish the playing field. Then I go on to discuss investors themselves, the elements that affect their investment success or lack of it, and the things they should do to improve their chances. The final chapters are an attempt to pull together both groups of ideas into a summation. Because my philosophy is of a piece, however, some ideas are relevant to more than one chapter. Please bear with me if you sense repetition. I hope you'll find this book's contents novel, thought-provoking, and perhaps even controversial. If anyone tells me, "I so enjoyed your book, it bore out everything I've ever read," I'll feel I failed. It's my goal to share ideas and ways of thinking about investment matters that you haven't come across before. Heaven for me would be 7 little words. I never thought of it that way. In particular, you'll find I spend more time discussing risk and how to limit it than how to achieve investment returns. To me, risk is the most interesting, challenging, and essential aspect of investing. When potential clients want to understand what makes Oaktree tick, their number one question is usually some variation on, what have been the keys to your success? My answer is simple: an effective investment philosophy, developed and honed over more than 4 decades, and implemented conscientiously by highly skilled individuals who share culture and values. Where does an investment philosophy come from? The one thing I'm sure of is that no one arrives on the doorstep of an investment career with his or her philosophy fully formed. A philosophy has to be the sum of many ideas accumulated over a long period of time from a variety of sources. One cannot develop an effective philosophy without having been exposed to life's lessons. In my life, I've been quite fortunate in terms of both rich experiences and powerful lessons. The time I spent at 2 great business schools provided a very effective and provocative combination: nuts and bolts and qualitative instruction in the pre-theory days of my undergraduate education at Wharton, and a theoretical, quantitative education at the Graduate School of Business of the University of Chicago. It's not the specific facts or processes I learned that mattered most, but being exposed to the 2 main schools of investment thought and having to ponder how to reconcile and synthesize them into my own approach. Importantly, a philosophy like mine comes from going through life with your eyes open. You must be aware of what's taking place in the world and of what results those events lead to. Only in this way can you put the lessons to work when similar circumstances materialize again. Failing to do this, more than anything else, is what dooms most investors to being victimized repeatedly by cycles of boom and bust. I like to say, experience is what you got when you didn't get what you wanted. Good times teach only bad lessons: that investing is easy, that you know its secrets, and that you needn't worry about risk. The most valuable lessons are learned in tough times. In that sense, I've been fortunate to have lived through some doozies: the Arab oil embargo, stagflation, Nifty 50 stock collapse and death of equities of the 1970s, Black Monday in 1987, when the Dow Jones Industrial Index lost 22.6% of its value in one day, the 1994 spike in interest rates that put rate-sensitive debt instruments into freefall, the emerging market crisis, Russian default and meltdown of long-term capital management in 1998, the bursting of the tech stock bubble in 2000-2001, the accounting scandals of 2001-2002, and the worldwide financial crisis of 2007-2008. Living through the 1970s was particularly formative, since so many challenges arose. It was virtually impossible to get an investment job during the 70s, meaning that in order to have experienced that decade, you had to have gotten your job before it started. How many of the people who started by the 60s were still working in the late 90s when the tech bubble rolled around? Not many. Most professional investors had joined the industry in the 80s or 90s and didn't know a market decline could exceed 5%, the greatest drop seen between 1982 and 1999. If you read widely, you can learn from people whose ideas merit publishing. Some of the most important for me were Charlie Ellis's great article, The Loser's Game, The Financial Analyst's Journal, July-August 1975, A Short History of Financial Euphoria by John Kenneth Galbraith, New York, Viking, 1990, and Nassim Nicholas Taleb's Fooled by Randomness, New York, Texer, 2001. Each did a great deal to shape my thinking. Finally, I've been extremely fortunate to learn directly from some outstanding thinkers: John Kenneth Galbraith on human foibles, Warren Buffett on patience and contrarianism, Charlie Munger on the importance of reasonable expectations, Bruce Newberg on probability and outcome, Michael Milken on conscious risk-bearing, and Rick Kane on setting traps, underrated investment opportunities where you can make a lot but can't lose a lot. I've also benefited from my association with Peter Bernstein, Seth Klarman, Jack Bogle, Jacob Rothschild, Jeremy Grantham, Joel Greenblatt, Tony Pace, Oren Kramer, Jim Grant and Doug Cass. The happy truth is that I was exposed to all of these elements and aware enough to combine them into the investment philosophy that has worked for my organizations, and thus for my clients, for many years. It's not the only right one. There are lots of ways to skin the cat, but it's right for us. I hasten to point out that my philosophy wouldn't have meant much without skilled implementation on the part of my incredible Oaktree co-founders, Bruce Karsh, Sheldon Stone, Larry Keel, Richard Masson, and Steve Kaplan, with whom I was fortunate to team up between 1983 and 1993. I'm convinced that no idea can be any better than the action taken on it, and that's especially true in the world of investing. The philosophy I share here wouldn't have attracted attention were it not for the accomplishments of these partners and the rest of my Oaktree colleagues. 1. The most important thing is second-level thinking. Few people have what it takes to be great investors. Some can be taught, but not everyone. And those who can be taught can't be taught everything. Valid approaches work some of the time, but not all. And investing can't be reduced to an algorithm and turned over to a computer. Even the best investors don't get it right every time. The reasons are simple. No rule always works. The environment isn't controllable, and circumstances rarely repeat exactly. Psychology plays a major role in markets, and because it's highly variable, cause and effect relationships aren't reliable. An investment approach may work for a while, but eventually the actions it calls for will change the environment, meaning a new approach is needed. And if others emulate an approach, that will blunt its effectiveness. Investing, like economics, is more art than science. And that means it can get a little messy. Because investing is at least as much art as it is science, it's never my goal, in this book or elsewhere, to suggest it can be routinized. In fact, one of the things I most want to emphasize is how essential it is that one's investment approach be intuitive and adaptive, rather than be fixed and mechanistic. At bottom, it's a matter of what you're trying to accomplish. Anyone can achieve average investment performance. Just invest in an index fund that buys a little of everything. That will give you what is known as market returns, merely matching whatever the market does. But successful investors want more. They want to beat the market. In my view, that's the definition of successful investing, doing better than the market and other investors. To accomplish that, you need either good luck or superior insight. Counting on luck isn't much of a plan, so you'd better concentrate on insight. In basketball, they say, you can't coach height, meaning all the coaching in the world won't make a player taller. It's almost as hard to teach insight. As with any other art form, some people just understand investing better than others. They have or manage to acquire that necessary trace of wisdom that Ben Graham so eloquently calls for. Everyone wants to make money. All of economics is based on belief in the universality of the profit motive. So is capitalism. The profit motive makes people work harder and risk their capital. The pursuit of profit has produced much of the material progress the world has enjoyed. But that universality also makes beating the market a difficult task. Millions of people are competing for each available dollar of investment gain. Who will get it? The person who's a step ahead. In some pursuits, getting to the front of the pack means more schooling, more time in the gym or the library, better nutrition, more perspiration, greater stamina, or better equipment. But in investing, where these things count for less, it calls for more perceptive thinking. At what I call the second level, would-be investors can take courses in finance and accounting, read widely, and, if they are fortunate, receive mentoring from someone with a deep understanding of the investment process. but only a few of them will achieve the superior insight, intuition, sense of value, and awareness of psychology that are required for consistently above-average results. Doing so requires second-level thinking. Remember, your goal in investing isn't to earn average returns. You want to do better than average. Thus, your thinking has to be better than that of others, both more powerful and at a higher level. Since other investors may be smart, well-informed, and highly computerized, you must find an edge they don't have. You must think of something they haven't thought of, see things they miss, or bring insight they don't possess. You have to react differently and behave differently. In short, being right may be a necessary condition for investment success, but it won't be sufficient. You must be more right than others, which by definition means your thinking has to be different. What is second-level thinking? First-level thinking is simplistic and superficial, and just about everyone can do it, a bad sign for anything involving an attempt at superiority. All the first-level thinker needs is an opinion about the future, as in, the outlook for the company is favorable, meaning the stock will go up. Second-level thinking is deep, complex, and convoluted. The second-level thinker takes a great many things into account. The difference in workload between first-level and second-level thinking is clearly massive, and the number of people capable of the latter is tiny compared to the number capable of the former. First-level thinkers look for simple formulas and easy answers. Second-level thinkers know that success in investing is the antithesis of simple. That's not to say you won't run into plenty of people who try their darndest to make it sound simple. Some of them I might characterize as mercenaries. Brokerage firms want you to think everyone's capable of investing at $10 per trade. Mutual fund companies don't want you to think you can do it. They want you to think they can do it. In that case, you'll put your money into actively managed funds and pay the associated high fees. Others who simplify are what I think of as proselytizers. Some are academics who teach investing. Others are well-intentioned practitioners who overestimate the extent to which they're in control. I think most of them fail to tote up their records, or they overlook their bad years or attribute losses to bad luck. Finally, there are those who simply fail to understand the complexity of the subject. A guest commentator on my drive time radio station says, "If you have had good experience with a product, buy the stock." There's so much more than that to being a successful investor. First-level thinkers think the same way other first-level thinkers do about the same things, and they generally reach the same conclusions. By definition, this can't be the route to superior results. All investors can't beat the market since, collectively, they are the market. Before trying to compete in the zero-sum world of investing, you must ask yourself whether you have good reason to expect to be in the top half. To outperform the average investor, you have to be able to outthink the consensus. Are you capable of doing so? What makes you think so? The problem is that extraordinary performance comes only from correct non-consensus forecasts, but non-consensus forecasts are hard to make correctly and hard to act on. Over the years, many people have told me that the matrix shown below had an impact on them. The upshot is simple. To achieve superior investment results, you have to hold non-consensus views regarding value, and they have to be accurate. That's not easy. For your performance to diverge from the norm, your expectations, and thus your portfolio, have to diverge from the norm, and you have to be more right than the consensus. Different and better. That's a pretty good description of second-level thinking. Those who consider the investment process simple generally aren't aware of the need for, or even the existence of, second-level thinking. Thus, many people are misled into believing that everyone can be a successful investor. Not everyone can. But the good news is that the prevalence of first-level thinkers increases the returns available to second-level thinkers. To consistently achieve superior investment returns, you must be one of them. 2. The most important thing is understanding market efficiency and its limitations. The 1960s saw the emergence of a new theory of finance and investing, a body of thought known as the Chicago School, because of its origins at the University of Chicago's Graduate School of Business. As a student there in 1967-1969, I found myself at ground zero for this new theory. It greatly informed and influenced my thinking. The theory included concepts that went on to become important elements in investment dialogue: risk aversion, volatility as the definition of risk, risk-adjusted returns, systematic and non-systematic risk, alpha, beta, the random walk hypothesis, and the efficient market hypothesis. All of these are addressed in the pages that follow. In the years since it was first proposed, that last concept has proved to be particularly influential in the field of investing, so significant that it deserves its own chapter. The most important upshot from the efficient market hypothesis is its conclusion that you can't beat the market. Not only was this conclusion founded logically on the Chicago view of the market, but it was buttressed by studies of the performance of mutual funds. Very few of those funds have distinguished themselves through their results. What about the five-star funds? You might ask. Read the small print. Mutual funds are rated relative to each other. The ratings don't say anything about their having beaten an objective standard such as a market index. Okay then, what about the celebrated investors we hear so much about? First, 1 or 2 good years prove nothing. Chance alone can produce just about any result. Second, statisticians insist nothing can be proved with statistical significance until you have enough years of data. I remember a figure of 64 years, and almost no one manages money that long. Finally, the emergence of 1 or 2 great investors doesn't disprove the theory. The fact that the Warren Buffetts of this world attract as much attention as they do is an indication that consistent outperformers are exceptional. One of the greatest ramifications of the Chicago theory has been the development of passive investment vehicles known as index funds. If most active portfolio managers making active bets on which securities to overweight and underweight can't beat the market, why pay the price, in the form of transaction costs and management fees, entailed in trying? With that question in mind, investors have put growing amounts in funds that simply invest a market-determined amount in each stock or bond in a market index. In this way, investors enjoy market returns at a fee of just a few hundredths of a percent per year. Everything moves in cycles, as I'll discuss later, and that includes accepted wisdom. So the efficient market hypothesis got off to a fast start in the 1960s and developed a lot of adherents. Objections have been raised since then, and the general view of its applicability rises and falls. I have my own reservations about the theory, and the biggest one has to do with the way it links return and risk. According to investment theory, people are risk-averse by nature, meaning that in general they'd rather bear less risk than more. For them to make riskier investments, they have to be induced through the promise of higher returns. Thus, markets will adjust the prices of investments so that, based on the known facts and common perceptions, the riskier ones will appear to promise higher returns. Because theory says in an efficient market there's no such thing as investing skill, commonly referred to today as alpha, that would enable someone to beat the market. All the difference in return between one investment and another, or between one person's portfolio and another's, is attributable to differences in risk. In fact, if you show an adherent of the efficient market hypothesis an investment record that appears to be superior, as I have, the answer is likely to be, the higher return is explained by hidden risk. The fallback position is to say, you don't have enough years of data. Once in a while, we experience periods when everything goes well, and riskier investments deliver the higher returns they seem to promise. Those halcyon periods lull people into believing that to get higher returns, all they have to do is make riskier investments. But they ignore something that is easily forgotten in good times. This can't be true, because if riskier investments could be counted on to produce higher returns, they wouldn't be riskier. Every once in a while, then, people learn an essential lesson. They realize that nothing, and certainly not the indiscriminate acceptance of risk, carries the promise of a free lunch, and they're reminded of the limitations of investment theory. That's the theory and its implications. The key question is whether it's right. Is the market unbeatable? Are the people who try wasting their time? Are the clients who pay fees to investment managers wasting their money? As with most other things in my world, the answers aren't simple. And they're certainly not yes or no. I don't believe the notion of market efficiency deserves to be dismissed out of hand. In principle, it's fair to conclude that if thousands of rational and numerate people gather information about an asset and evaluate it diligently and objectively, the asset's price shouldn't stray far from its intrinsic value. Mispricings shouldn't be regularly extant, meaning it should be hard to beat the market. In fact, some asset classes are quite efficient. In most of these, if these conditions are met, there's no reason why the asset class should systematically be overlooked, misunderstood, or underrated. Take foreign exchange, for example. What are the things that determine the movements of one currency versus another? Future growth rates and inflation rates. Is it possible for any one person to systematically know much more about these things than everyone else? Probably not. And if not, then no one should be able to regularly achieve above-average risk-adjusted returns through currency trading. What about the major stock markets, such as the New York Stock Exchange? Here millions of people are prospecting, driven by the desire for profit. They're all similarly informed. In fact, it's one of the goals of our market regulation that everyone should gain access to the same company information at the same time. With millions of people doing similar analysis on the basis of similar information, how often will stocks become mispriced, and how regularly can any one person detect those mispricings? Answer: not often and not dependably. But that is the essence of second-level thinking. Second-level thinkers know that, to achieve superior results, they have to have an edge in either information or analysis, or both. They are on the alert for instances of misperception. My son Andrew is a budding investor, and he comes up with lots of appealing investment ideas based on today's facts and the outlook for tomorrow. But he's been well trained. His first test is always the same, and who doesn't know that? In the vocabulary of the theory, second-level thinkers depend on inefficiency. The term inefficiency came into widespread use over the last 40 years as the counterpoint to the belief that investors can't beat the market. To me, describing a market as inefficient is a high-flown way of saying the market is prone to mistakes that can be taken advantage of. Where might errors come from? Let's consider the assumptions that underlie the theory of efficient markets. For those reasons, theory says that all the available information will be smoothly and efficiently synthesized into prices and acted on whenever price-value discrepancies arise, so as to drive out those discrepancies. But it's impossible to argue that market prices are always right. In fact, if you look at the four assumptions just listed, one stands out as particularly tenuous: objectivity. Human beings are not clinical computing machines. Rather, most people are driven by greed, fear, envy, and other emotions that render objectivity impossible and open the door for significant mistakes. Likewise, what about the fourth assumption? Whereas investors are supposed to be open to any asset and to both owning it and being short, the truth is very different. Most professionals are assigned to particular market niches, as in I work in the equity department or I'm a bond manager. And the percentage of investors who ever sell short is truly tiny. Who then makes and implements the decisions that would drive out relative mispricings between asset classes? A market characterized by mistakes and mispricings can be beaten by people with rare insight. Thus, the existence of inefficiencies gives rise to the possibility of outperformance and is a necessary condition for it. It does not, however, guarantee it. In the great debate over efficiency versus inefficiency, I have concluded that no market is completely one or the other. It's just a matter of degree. I wholeheartedly appreciate the opportunities that inefficiency can provide, but I also respect the concept of market efficiency, and I believe strongly that mainstream securities markets can be so efficient that it's largely a waste of time to work at finding winners there. In the end, I've come to an interesting resolution. Efficiency is not so universal that we should give up on superior performance. At the same time, efficiency is what lawyers call a rebuttable presumption, something that should be presumed to be true until someone proves otherwise. Therefore, we should assume that efficiency will impede our achievement, unless we have good reason to believe it won't in the present case. Respect for efficiency says that before we embark on a course of action, we should ask some questions. Have mistakes and mispricings been driven out through investors' concerted efforts, or do they still exist, and why? Think of it this way. Something else to keep in mind. Just because efficiencies exist today doesn't mean they'll remain forever. Bottom line, inefficiency is a necessary condition for superior investing. Attempting to outperform in a perfectly efficient market is like flipping a fair coin. The best you can hope for is 50-50. For investors to get an edge, there have to be inefficiencies in the underlying process, imperfections, mispricings, to take advantage of. But let's say there are. That alone is not a sufficient condition for outperformance. All that means is that prices aren't always fair and mistakes are occurring. Some assets are priced too low and some too high. You still have to be more insightful than others in order to regularly buy more of the former than the latter. Many of the best bargains at any point in time are found among the things other investors can't or won't do. Let others believe markets can never be beat. Abstention on the part of those who won't venture and creates opportunities for those who will. Is investment theory, with its notion of market efficiency, the equivalent of a physical law that is universally true? Or is it an irrelevant ivory tower notion to be disregarded? In the end, it's a question of balance, and balance comes from applying informed common sense. The key turning point in my investment management career came when I concluded that, because the notion of market efficiency has relevance, I should limit my efforts to relatively inefficient markets where hard work and skill would pay off best. Theory informed that decision and prevented me from wasting my time in the mainstream markets, but it took an understanding of the limits of the theory to keep me from completely accepting the arguments against active management. 3. The most important thing is value. The oldest rule in investing is also the simplest: buy low, sell high. Seems blindingly obvious. Who would want to do anything else? But what does that rule actually mean? Again, obvious on the surface. It means that you should buy something at a low price and sell it at a high price. But what in turn does that mean? What's high and what's low? On a superficial level, you can take it to mean that the goal is to buy something for less than you sell it for. But since your sale will take place well down the road, that's not much help in figuring out the proper price at which to buy today. There has to be some objective standard for high and low, and most usefully that standard is the asset's intrinsic value. Now the meaning of the saying becomes clear. Buy at a price below intrinsic value and sell at a higher price. Of course, to do that, you'd better have a good idea what intrinsic value is. For me, an accurate estimate of value is the indispensable starting point. To simplify or oversimplify, all approaches to investing in company securities can be divided into two basic types: those based on analysis of the company's attributes, known as fundamentals, and those based on study of the price behavior of the securities themselves. In other words, an investor has two basic choices: gauge the security's underlying intrinsic value and buy or sell when the price diverges from it, or base decisions purely on expectations regarding future price movements. I'll turn to the latter first, since I don't believe in it and should be able to dispose of it rather promptly. Technical analysis, or the study of past stock price behavior, has been practiced ever since I joined the industry, and well before that, but it's been in decline. Today, observations about historic price patterns may be used to supplement fundamental analysis, but we hear far less than we did in the past about people basing decisions primarily on what price movements tell them. Part of the decline of technical analysis can be attributed to the random walk hypothesis, a component of the Chicago theory developed in the early 1960s, primarily by Professor Eugene Fama. The random walk hypothesis says a stock's past price movements are of absolutely no help in predicting future movements. In other words, it's a random process, like tossing a coin. We all know that even if a coin has come up heads 10 times in a row, the probability of heads on the next throw is still 50-50. Likewise, the hypothesis says, the fact that a stock's price has risen for the last 10 days tells you nothing about what it will do tomorrow. Another form of relying on past stock price movements to tell you something is so-called momentum investing. It, too, exists in contravention of the random walk hypothesis. I'm unlikely to do it justice. But as I see it, investors who practice this approach operate under the assumption that they can tell when something that has been rising will continue to rise. Momentum investing might enable you to participate in a bull market that continues upward, but I see a lot of drawbacks. One is based on economist Herb Stein's wry observation that if something cannot go on forever, it will stop. What happens to momentum investors then? How will this approach help them sell in time to avoid a decline? And what will it have them do in falling markets? It seems clear that momentum investing isn't a cerebral approach to investing. The greatest example came in 1998-1999, with the rise of people called day traders. Most were non-professional investors drawn from other walks of life by the hope for easy money in the tech media telecom stock boom. They rarely held positions overnight, since doing so would require them to pay for them. Several times a day, they would try to guess whether a stock they'd been watching would rise or fall in the next few hours. I've never understood how people reach conclusions like these. I liken it to trying to guess whether the next person to come around the corner will be male or female. The way I see it, day traders considered themselves successful if they bought a stock at $10 and sold at $11, bought it back the next week at $24 and sold at $25, and bought it a week later at $39 and sold at $40. If you can't see the flaw in this, that the trader made $3 in a stock that appreciated by $30, you probably shouldn't read the rest of this book. moving away from momentum investors and their Ouija boards, along with all other forms of investing that eschew intelligent analysis. We are left with two approaches, both driven by fundamentals: value investing and growth investing. In a nutshell, value investors aim to come up with a security's current intrinsic value and buy when the price is lower, and growth investors try to find securities whose value will increase rapidly in the future. Yep. Yep. What is it that makes a security or the underlying company valuable? There are lots of candidates: financial resources, management, factories, retail outlets, patents, human resources, brand names, growth potential, and most of all, the ability to generate earnings and cash flow. In fact, most analytical approaches would say that all those other characteristics, financial resources, management, factories, retail outlets, patents, human resources, brand names, and growth potential, are valuable precisely because they can translate eventually into earnings and cash flow. The emphasis in value investing is on tangible factors like hard assets and cash flows. Intangibles like talent, popular fashions, and long-term growth potential are given less weight. Certain strains of value investing focus exclusively on hard assets. There's even something called net investing, in which people buy when the total market value of a company's stock is less than the amount by which the company's current assets, such as cash, receivables, and inventories, exceed its total liabilities. In this case, in theory, you could buy all the stock, liquidate the current assets, pay off the debts, and end up with the business and some cash. Pocket cash equal to your cost, and with more left over you'll have paid less than nothing for the business. The quest in value investing is for cheapness. Value investors typically look at financial metrics such as earnings, cash flow, dividends, hard assets, and enterprise value and emphasize buying cheap on these bases. The primary goal of value investors, then, is to quantify the company's current value and buy its securities when they can do so cheaply. Growth investing lies somewhere between the dull plodding of value investing and the adrenaline charge of momentum investing. Its goal is to identify companies with bright futures. That means by definition that there's less emphasis on the company's current attributes and more on its potential. It would be convenient to say that adherence to value investing permits investors to avoid conjecture about the future, and that growth investing consists only of conjecture about the future. But that would be a considerable exaggeration. After all, establishing the current value of a business requires an opinion regarding its future, and that in turn must take into account the likely macroeconomic environment, competitive developments, and technological advances. Even a promising net investment can be doomed if the company's assets are squandered on money-losing operations or unwise acquisitions. There's no bright-line distinction between value and growth. Both require us to deal with the future. Value investors think about the company's potential for growth, and the growth at a reasonable price. School pays explicit homage to value. It's all a matter of degree. However, I think it can fairly be said that growth investing is about the future, whereas value investing emphasizes current-day considerations but can't escape dealing with the future. For an extreme example of growth investing, let me take you back to the days of the Nifty 50, a fad that epitomized the contrast with value investing and demonstrates how far a growth mania can go. In 1968, I had my first job in the investment management industry as a summer employee in the investment research department of First National City Bank, now Citibank. The bank followed an approach known as Nifty 50 investing. Its goal was to identify the companies with the brightest outlook for earnings growth over the long term. In addition to growth rate, the bank's investment managers stressed quality. by which they meant a high probability that the growth expectations would be realized. It was official dictum that if a company was growing fast enough and of sufficient quality, the price paid for the stock didn't matter. If a stock is expensive based on today's metrics, give it a few years and it'll grow into its price. Then, as now, growth stock portfolios were heavily weighted toward drugs, technology, and consumer products. The bank's portfolios included highly respected names such as IBM, Xerox, Kodak, Polaroid, Merck, Eli Lilly, Avon, Coca-Cola, Philip Morris, Hewlett-Packard, Motorola, Texas Instruments, and PerkinElmer, America's great companies, all with bright outlooks for growth. Since nothing could go wrong at these companies, there was no hesitance to pay up for their stocks. Fast forward a couple of decades, and what do you see in that list of companies? Some, such as Kodak and Polaroid, have seen their basic businesses decimated by unforeseen changes in technology. Others, such as IBM and Xerox, became slow-moving prey on which new competitors feasted. All told, First National City's list of America's best companies has been visited by deterioration and even bankruptcy in the 42 years since I started. So much for the long-term persistence of growth and for the ability to predict it accurately. Compared to value investing, growth investing centers around trying for big winners. If big winners weren't in the offing, why put up with the uncertainty entailed in guessing at the future? There's no question about it. It's harder to see the future than the present. Thus, the batting average for growth investors should be lower, but the payoff for doing it well might be higher. The return for correctly predicting which companies will come up with the best new drug, most powerful computer, or best-selling movies should be substantial. In general, the upside potential for being right about growth is more dramatic, and the upside potential for being right about value is more consistent. Value is my approach. In my book, Consistency Trumps Drama. If value investing has the potential to consistently produce favorable results, does that mean it's easy? No. For one thing, it depends on an accurate estimate of value. Without that, any hope for consistent success as an investor is just that, hope. Without accurate estimates, you'll be as likely to overpay as to underpay. And if you overpay, it takes a surprising improvement in value, a strong market, or an even less discriminating buyer, what we used to call a greater fool, to bail you out. There's more. If you've settled on the value approach to investing and come up with an intrinsic value for a security or asset, the next important thing is to hold it firmly. That's because in the world of investing, being correct about something isn't at all synonymous with being proved correct right away. It's hard to consistently do the right thing as an investor, but it's impossible to consistently do the right thing at the right time. The most we value investors can hope for is to be right about an asset's value and buy when it's available for less. But doing so today certainly doesn't mean you're going to start making money tomorrow. A firmly held view on value can help you cope with this disconnect. Let's say you figure out that something's worth 80 and have a chance to buy it for 60. Chances to buy well below actual value don't come along every day, and you should welcome them. Warren Buffett describes them as buying dollars for 50 cents. So you buy it and you feel you've done a good thing. But don't expect immediate success. In fact, you'll often find that you've bought in the midst of a decline that continues. Pretty soon, you'll be looking at losses. And as one of the greatest investment adages reminds us, being too far ahead of your time is indistinguishable from being wrong. So now that security worth 80 is priced at 50 instead of 60. What do? We learn in Microeconomics 101 that the demand curve slopes downward to the right. As the price of something goes up, the quantity demanded goes down. In other words, people want less of something at higher prices and more of it at lower prices. Makes sense. That's why stores do more business when goods go on sale. It works that way in most places, but far from always, it seems, in the world of investing. There, many people tend to fall further in love with the thing they've bought as its price rises, since they feel validated, and they like it less as the price falls, when they begin to doubt their decision to buy. This makes it very difficult to hold and to buy more at lower prices, which investors call averaging down, especially if the decline proves to be extensive. If you liked it at 60, you should like it more at 50, and much more at 40 and 30. But it's not that easy. No one's comfortable with losses, and eventually any human will wonder, maybe it's not me who's right. Maybe it's the market. The danger is maximized when they start to think, it's down so much, I'd better get out before it goes to zero. That's the kind of thinking that makes bottoms and causes people to sell there. An accurate opinion on valuation, loosely held, will be of limited help. An incorrect opinion on valuation, strongly held, is far worse. This one statement shows how hard it is to get it all right. Give most investors, and certainly most amateur investors, a dose of truth serum and then ask this question: what's your approach to investing? The inevitable answer: I look for things that will go up. But the serious pursuit of profit has to be based on something more tangible. In my view, the best candidate for that something tangible is fundamentally derived intrinsic value. An accurate estimate of intrinsic value is the essential foundation for steady, unemotional, and potentially profitable investing. Value investors score their biggest gains when they buy an underpriced asset, average down unfailingly, and have their analysis proved out. Thus, there are two essential ingredients for profit in a declining market. You have to have a view on intrinsic value, and you have to hold that view strongly enough to be able to hang in and buy, even as price declines suggest that you're wrong. Oh yes, there's a third: you have to be right. 4. The most important thing is the relationship between price and value. Let's say you've become convinced of the efficacy of value investing, and you're able to come up with an estimate of intrinsic value for a stock or other asset. Let's even say your estimate is right. You're not done. In order to know what action to take, you have to look at the asset's price relative to its value. Establishing a healthy relationship between fundamentals, value, and price is at the core of successful investing. It's a fundamental premise of the efficient market hypothesis, and it makes perfect sense that if you buy something for its fair value, you can expect a return that is fair given the risk. But active investors aren't in it for fair risk-adjusted returns. They want superior returns. If you'll be satisfied with fair returns, why not invest passively in an index fund and save a lot of trouble? So buying something at its intrinsic value is no great shakes. And paying more than something's worth is clearly a mistake. It takes a lot of hard work or a lot of luck to turn something bought at a too high price into a successful investment. Remember the Nifty 50 investing I described in the last chapter. At their highs, many of those stalwart companies sported price-earnings ratios, the ratio of the stock's price to the earnings behind each share, between 80 and 90. For comparison, the post-war average price-earnings ratio for stocks in general has been in the mid-teens. None of their partisans appeared to be worried about those elevated valuations. Then, in just a few years, everything changed. In the early 1970s, the stock market cooled off. Exogenous factors like the oil embargo and rising inflation clouded the picture, and the Nifty 50 stocks collapsed. Within a few years, those price-earnings ratios of 80 or 90 had fallen to 8 or 9, meaning investors in America's best companies had lost 90% of their money. People may have bought into great companies, but they paid the wrong price. At Oaktree we say, well bought is half sold. By this we mean we don't spend a lot of time thinking about what price we're going to be able to sell a holding for, or when, or to whom, or through what mechanism. If you've bought it cheap, eventually those questions will answer themselves. If your estimate of intrinsic value is correct, over time, an asset's price should converge with its value. All of this begs the question, what goes into the price? What should a prospective buyer be looking at to be sure the price is right? Underlying fundamental value, of course, but most of the time a security's price will be affected at least as much, and its short-term fluctuations determined primarily by two other factors, psychology and technicals. Most investors, and certainly most non-professionals, know little about technicals. These are non-fundamental factors, that is, things unrelated to value that affect the supply and demand for securities. Two examples. The forced selling that takes place when market crashes cause levered investors to receive margin calls and be sold out, and the inflows of cash to mutual funds that require portfolio managers to buy. In both cases, people are forced to enter into securities transactions without much regard for price. Believe me, there's nothing better than buying from someone who has to sell regardless of price during a crash. Many of the best buys we've ever made occurred for that reason. A couple of observations are in order, however. And that brings me to the second factor that exerts such a powerful influence on price, psychology. It's impossible to overstate how important this is. In fact, it's so vital that several later chapters are devoted to discussing investor psychology and how to deal with its manifestations. Whereas the key to ascertaining value is skilled financial analysis, the key to understanding the price-value relationship and the outlook for it lies largely in insight into other investors' minds. Investor psychology can cause a security to be priced just about anywhere in the short run, regardless of its fundamentals. Clearly, this is yet another area that is of critical importance and b, extremely hard to master. First, psychology is elusive. And second, the psychological factors that weigh on other investors' minds and influence their actions will weigh on yours as well. As you will read in later chapters, these forces tend to cause people to do the opposite of what a superior investor must do. For self-protection, then, you must invest the time and energy to understand market psychology. It's essential to understand that fundamental value will be only one of the factors determining a security's price on the day you buy it. Try to have psychology and technicals on your side as well. The polar opposite of conscientious value investing is mindlessly chasing bubbles, in which the relationship between price and value is totally ignored. All bubbles start with some nugget of truth. A few clever investors figure out, or perhaps even foresee, these truths, invest in the asset and begin to show profits. Then others catch on to the idea, or just notice that people are making money, and they buy as well, lifting the asset's price. But as the price rises further, and investors become more inflamed by the possibility of easy money, they think less and less about whether the price is fair. It's an extreme rendition of the phenomenon I described earlier. People should like something less when its price rises, but in investing they often like it more. In 2004-2006, for example, people could conjure up only good things about houses and condos, the desirability of participating in the American dream of home ownership, the ability to benefit from inflation, the fact that mortgage loans were cheap and payments would be tax deductible, and ultimately the accepted wisdom that home prices only go up. We all know what happened to that little nugget of wisdom. And what of that other infamous, can't lose idea. In the tech bubble, buyers didn't worry about whether a stock was priced too high because they were sure someone else would be willing to pay them more for it. Unfortunately, the greater fool theory works only until it doesn't. Valuation eventually comes into play, and those who are holding the bag when it does have to face the music. Yep. The problem is that in bubbles, attractive morphs into attractive at any price. People often say, "It's not cheap, but I think it'll keep going up because of excess liquidity," or any number of other reasons. In other words, they say, "It's fully priced, but I think it'll become more so." Buying or holding on that basis is extremely chancy, but that's what makes bubbles. In bubbles, infatuation with market momentum takes over from any notion of value and fair price, and greed, plus the pain of standing by as others make seemingly easy money, neutralizes any prudence that might otherwise hold sway. To sum up, I believe that an investment approach based on solid value is the most dependable. In contrast, counting on others to give you a profit regardless of value, relying on a bubble, is probably the least. Consider the possible routes to investment profit. Of all the possible routes to investment profit, buying cheap is clearly the most reliable. Even that, however, isn't sure to work. You can be wrong about the current value, or events can come along that reduce value, or deterioration in attitudes or markets can make something sell even further below its value. Or the convergence of price and intrinsic value can take more time than you have. As John Maynard Keynes pointed out, the market can remain irrational longer than you can remain solvent. Trying to buy below value isn't infallible, but it's the best chance we have. 5. The most important thing is understanding risk. Investing consists of exactly one thing: dealing with the future. And because none of us can know the future with certainty, risk is inescapable. Thus, dealing with risk is an essential, I think the essential, element in investing. It's not hard to find investments that might go up. If you can find enough of these, you'll have moved in the right direction. But you're unlikely to succeed for long if you haven't dealt explicitly with risk. The first step consists of understanding it. The second step is recognizing when it's high. The critical final step is controlling it. Because the issue is so complex and so important, I devote 3 chapters to examining risk in depth. Why do I say risk assessment is such an essential element in the investment process? There are 3 powerful reasons. First, risk is a bad thing, and most level-headed people want to avoid or minimize it. It is an underlying assumption in financial theory that people are naturally risk-averse, meaning they'd rather take less risk than more. Thus, for starters, an investor considering a given investment has to make judgments about how risky it is and whether he or she can live with the absolute quantum of risk. Second, when you're considering an investment, your decision should be a function of the risk entailed as well as the potential return. Because of their dislike for risk, investors have to be bribed with higher prospective returns to take incremental risks. Put simply, if both a U.S. Treasury note and small company stock appeared likely to return 7% per year, everyone would rush to buy the former, driving up its price and reducing its prospective return, and dump the latter, driving down its price and thus increasing its return. This process of adjusting relative prices, which economists call equilibration, is supposed to render prospective returns proportional to risk. So, going beyond determining whether he or she can bear the absolute amount of risk that is attendant, the investor's second job is to determine whether the return on a given investment justifies taking the risk. Clearly, return tells just half of the story, and risk assessment is required. Third, when you consider investment results, the return means only so much by itself. The the risk taken has to be assessed as well. Was the return achieved in safe instruments or risky ones? In fixed income securities or stocks? In large, established companies or smaller, shakier ones? In liquid stocks and bonds or illiquid private placements? With help from leverage or without it? In a concentrated portfolio or a diversified one? Surely investors who get their statements and find that their accounts made 10% for the year don't know whether their money managers did a good job or a bad one. In order to reach a conclusion, they have to have some idea about how much risk their managers took. In other words, they have to have a feeling for risk-adjusted return. It is from the relationship between risk and return that arises the graphic representation that has become ubiquitous in the investment world. Figure 5.1. It shows a capital market line that slopes upward to the right, indicating the positive relationship between risk and return. Markets set themselves up so that riskier assets appear to offer higher returns. If that weren't the case, who would buy them? Figure 5.1. The familiar graph of the risk-return relationship is elegant in its simplicity. Unfortunately, many have drawn from it an erroneous conclusion that gets them into trouble. Our next major task is to define risk. What exactly does it involve? We can get an idea from its synonyms: danger, hazard, jeopardy, peril. They all sound like reasonable candidates and pretty undesirable. And yet, finance theory, the same theory that contributed the risk-return graph shown in Figure 5.1, and the concept of risk adjustment, defines risk very precisely as volatility or variability or deviation. None of these conveys the necessary sense of peril. The possibility of permanent loss is the risk I worry about, Oaktree worries about, and every practical investor I know worries about. But there are many other kinds of risk, and you should be conscious of them, because they can either affect you or B, affect others and thus present you with opportunities for profit. Now, I want to spend a little time on the subject of what gives rise to the risk of loss. First, risk of loss does not necessarily stem from weak fundamentals. A fundamentally weak asset, a less-than-stellar company's stock, a speculative-grade bond, or a building in the wrong part of town, can make for a very successful investment if bought at a low enough price. Second, risk can be present even without weakness in the macro environment. The combination of arrogance, failure to understand and allow for risk, and a small adverse development can be enough to wreak havoc. It can happen to anyone who doesn't spend the time and effort required to understand the processes underlying his or her portfolio. Mostly it comes down to psychology that's too positive, and thus prices that are too high. Investors tend to associate exciting stories and pizzazz with high potential returns. They also expect high returns from things that have been doing well lately. These souped-up investments may deliver on people's expectations for a while, but they certainly entail high risk. Having been borne aloft on the crowd's excitement and elevated to what I call the pedestal of popularity, they offer the possibility of continued high returns, but also of low or negative ones. Theory says high return is associated with high risk because the former exists to compensate for the latter. But pragmatic value investors feel just the opposite. They believe high return and low risk can be achieved simultaneously by buying things for less than their worth. In the same way, overpaying implies both low return and high risk. Dull, ignored, possibly tarnished and beaten down securities, often bargains exactly because they haven't been performing well, are often the ones value investors favor for high returns. Their returns in bull markets are rarely at the top of the heap, but their performance is generally excellent on average, more consistent than that of hot stocks and characterized by low variability, low fundamental risk and smaller losses when markets do badly. Much of the time, the greatest risk in these low-luster bargains lies in the possibility of underperforming in heated bull markets. That's something the risk-conscious value investor is willing to live with. I'm sure we agree that investors should and do demand higher prospective returns on the investments they perceive as riskier. And hopefully, we can agree that losing money is the risk people care about most in demanding prospective returns, and thus in setting prices for investments. An important question remains: how do they measure that risk? First, it clearly is nothing but a matter of opinion, hopefully an educated, skillful estimate of the future, but still just an estimate. Second, the standard for quantification is non-existent. With any given investment, some people will think the risk is high, and others will think it's low. Some will state it as the probability of not making money, and some as the probability of losing a given fraction of their money, and so forth. Some will think of it as the risk of losing money over 1 year, and some as the risk of losing money over the entire holding period. Clearly, even if all the investors involved met in a room and showed their cards, they'd never agree on a single number representing an investment's riskiness. And even if they could, that number wouldn't likely be capable of being compared against another number, set by another group of investors, for another investment. This is one of the reasons why I say risk and the risk-return decision aren't machinable or capable of being turned over to a computer. Ben Graham and David Dodd put it this way more than 60 years ago in the second edition of Security Analysis, the Bible of Value Investors. The relation between different kinds of investments and the risk of loss is entirely too indefinite and too variable with changing conditions to permit of sound mathematical formulation. Third, risk is deceptive. Conventional considerations are easy to factor in, like the likelihood that normally recurring events will recur. But freakish, once-in-a-lifetime events are hard to quantify. The fact that an investment is susceptible to a particularly serious risk that will occur infrequently, if at all, what I call the improbable disaster, means it can seem safer than it really is. The bottom line is that, looked at prospectively, much of risk is subjective, hidden and unquantifiable. Where does that leave us? If the risk of loss can't be measured, quantified, or even observed, and if it's consigned to subjectivity, how can it be dealt with? Skillful investors can get a sense for the risk present in a given situation. They make that judgment primarily based on a. The stability and dependability of value, and b. the relationship between price and value. Other things will enter into their thinking, but most will be subsumed under these two. There have been many efforts of late to make risk assessment more scientific. Financial institutions routinely employ quantitative risk managers, separate from their asset management teams, and have adopted computer models such as value at risk to measure the risk in a portfolio. But the results produced by these people and their tools will be no better than the inputs they rely on and the judgments they make about how to process the inputs. In my opinion, they'll never be as good as the best investors' subjective judgments. Given the difficulty of quantifying the probability of loss, investors who want some objective measure of risk-adjusted return, and they are many, can only look to the so-called Sharpe ratio. This is the ratio of a portfolio's excess return, its return above the riskless rate, or the rate on short-term treasury bills, to the standard deviation of the return. This calculation seems serviceable for public market securities that trade and price often. There is some logic, and it truly is the best we have. While it says nothing explicitly about the likelihood of loss, there may be reason to believe that the prices of fundamentally riskier securities fluctuate more than those of safer ones, and thus that the Sharpe ratio has some relevance. For private assets lacking market prices, like real estate and whole companies, there's no alternative to subjective risk adjustment. A few years ago, while considering the difficulty of measuring risk prospectively, I realized that because of its latent, non-quantitative and subjective nature, the risk of an investment, defined as the likelihood of loss, can't be measured in retrospect any more than it can a priori. Let's say you make an investment that works out as expected. Does that mean it wasn't risky? Maybe you buy something for $100 and sell it a year later for $200. Was it risky? Who knows? Perhaps it exposed you to great potential uncertainties that didn't materialize. Thus, its real riskiness might have been high. Or let's say the investment produces a loss. Does that mean it was risky? Or that it should have been perceived as risky at the time it was analyzed and entered into? If you think about it, the response to these questions is simple. The fact that something, in this case, loss, happened doesn't mean it was bound to happen, and the fact that something didn't happen doesn't mean it was unlikely. Fooled by Randomness, by Nassim Nicholas Taleb, is the authority on this subject as far as I'm concerned, and in it he talks about the alternative histories that could have unfolded but didn't. There's more about this important book in chapter 16, but at the moment I am interested in how the idea of alternative histories relates to risk. Yes, yes. And that brings me to the quotation from L. Ray Dimson that led off this chapter. Risk means more things can happen than will happen. Now we move toward the metaphysical aspects of risk. Perhaps you recall the opening sentence of this chapter. Investing consists of exactly one thing, dealing with the future. Yet clearly it's impossible to know anything about the future. If we're farsighted, we can have an idea of the range of future outcomes and their relative likelihood of occurring. That is, we can fashion a rough probability distribution. On the other hand, if we're not, we won't know these things and it'll be pure guesswork. If we have a sense for the future, we'll be able to say which outcome is most likely, what other outcomes also have a good chance of occurring, how broad the range of possible outcomes is, and thus what the expected result is. The expected result is calculated by weighting each outcome by its probability of occurring. It's a figure that says a lot, but not everything, about the likely future. But even when we know the shape of the probability distribution, which outcome is most likely, and what the expected result is, and even if our expectations are reasonably correct, we know about only likelihoods or tendencies. I've spent hours playing gin and backgammon with my good friend Bruce Newberg. Our time spent with cards and dice, where the odds are absolutely knowable, demonstrates the significant role played by randomness, and thus the vagary of probabilities. Bruce has put it admirably into words. There's a big difference between probability and outcome. Probable things fail to happen, and improbable things happen all the time. That's one of the most important things you can know about investment risk. While on the subject of probability distributions, I want to take a moment to make special mention of the normal distribution. Obviously, investors are required to make judgments about future events. To do that, we settle on a central value around which we think events are likely to cluster. This may be the mean or expected value, the outcome that on average is expected to occur. The median, the outcome with half the possibilities above and half below, or the mode, the single most likely outcome. But to cope with the future, it's not sufficient to have a central expectation. We have to have a sense for the other possible outcomes and their likelihood. We need a distribution that describes all of the possibilities. Most phenomena that cluster around a central value, for example, the heights of people, form the familiar bell-shaped curve, with the probability of a given observation peaking at the center and trailing off toward the extremes or tails. There may be more men of 5 feet 10 inches than any other height, somewhat fewer of 5 feet 9 inches or 5 feet 11 inches, a lot less of 5 feet 3 inches or 6 feet 5 inches, and almost none of 4 feet 8 inches or 7 feet. Rather than enumerating the probability of each observation individually, standard distributions provide a convenient way to summarize the probabilities, such that a few statistics can tell you everything you have to know about the shape of things to come. The most common bell-shaped distribution is called the normal distribution. However, people often use the terms bell-shaped and normal interchangeably, and they're not the same. The former is a general type of distribution, while the latter is a specific bell-shaped distribution with very definite statistical properties. Failure to distinguish between the two doubtless made an important contribution to the recent credit crisis. In the years leading up to the crisis, financial engineers, or quants, played a big part in creating and evaluating financial products such as derivatives and structured entities. In many cases, they made the assumption that future events would be normally distributed. But the normal distribution assumes events in the distant tails will happen extremely infrequently, while the distribution of financial developments, shaped by humans, with their tendency to go to emotion-driven extremes of behavior, should probably be seen as having fatter tails. Thus, when widespread mortgage defaults began to occur, events thought to be unlikely befell mortgage-related vehicles on a regular basis. Investors in vehicles that had been constructed on the basis of normal distributions, without much allowance for tail events, some might borrow Nassim Nicholas Taleb's term black swans, often saw the wheels come off. Now that investing has become so reliant on higher math, we have to be on the lookout for occasions when people wrongly apply simplifying assumptions to a complex world. Quantification often lends excessive authority to statements that should be taken with a grain of salt. That creates significant potential for trouble. Here's the key to understanding risk. It's largely a matter of opinion. It's hard to be definitive about risk, even after the fact. You can see that one investor lost less than another in bad times and conclude that that investor took less risk. Or you can note that one investment declined more than another in a given environment and thus say it was riskier. Are these statements necessarily accurate? For the most part, I think it's fair to say that investment performance is what happens when a set of developments, geopolitical, macroeconomic, company-level, technical and psychological, collide with an extant portfolio. Many futures are possible, to paraphrase Dimson, but only one future occurs. The future you get may be beneficial to your portfolio or harmful, and that may be attributable to your foresight, prudence, or luck. The performance of your portfolio under the one scenario that unfolds says nothing about how it would have fared under the many alternative histories that were possible. Return alone, and especially return over short periods of time, says very little about the quality of investment decisions. Return has to be evaluated relative to the amount of risk taken to achieve it. And yet, risk cannot be measured. Certainly, it cannot be gauged on the basis of what everybody says at a moment in time. Risk can be judged only by sophisticated, experienced second-level thinkers. Here's my wrap-up on understanding risk. 6. The most important thing is recognizing risk. Great investing requires both generating returns and controlling risk. And recognizing risk is an absolute prerequisite for controlling it. Hopefully, I've made clear what I think risk is and isn't. Risk means uncertainty about which outcome will occur, and about the possibility of loss when the unfavorable ones do. The next important step is to describe the process through which risk can be recognized for what it is. Recognizing risk often starts with understanding when investors are paying it too little heed, being too optimistic, and paying too much for a given asset as a result. High risk, in other words, comes primarily with high prices. Whether it be an individual security or other asset that is overrated and thus overpriced, or an entire market that's been borne aloft by bullish sentiment, and thus is sky high. Participating when prices are high rather than shying away is the main source of risk. Whereas the theorist thinks return and risk are two separate things, albeit correlated, the value investor thinks of high risk and low prospective return as nothing but two sides of the same coin, both stemming primarily from high prices. Thus, awareness of the relationship between price and value, whether for a single security or an entire market, is an essential component of dealing successfully with risk. Risk arises when markets go so high that prices imply losses rather than the potential rewards they should. Dealing with this risk starts with recognizing it. So a prime element in risk creation is a belief that risk is low, perhaps even gone altogether. That belief drives up prices and leads to the embrace of risky actions despite the lowness of prospective returns. In 2005-2007, belief that risk had been banished caused prices to rise to bubble levels and investors to participate in what later turned out to be risky activities. This is one of the most dangerous of all processes, and its tendency to recur is remarkable. The risk is gone myth is one of the most dangerous sources of risk, and a major contributor to any bubble. At the extreme of the pendulum's upswing, the belief that risk is low, and that the investment in question is sure to produce profits intoxicates the herd and causes its members to forget caution, worry and fear of loss, and instead to obsess about the risk of missing opportunity. Investment risk comes primarily from too high prices, and too high prices often come from excessive optimism and inadequate skepticism and risk aversion. Contributing underlying factors can include low prospective returns on safer investments, recent good performance by risky ones, strong inflows of capital, and easy availability of credit. The key lies in understanding what impact things like these are having. The investment thought process is a chain in which each investment sets the requirement for the next. Here, how I described the process in 2004. This richening process eventually brings on elevated price-earnings ratios, narrow credit spreads, undisciplined investor behavior, heavy use of leverage and strong demand for investment vehicles of all types. Just as these things raise prices and reduce prospective return, they also create a high-risk environment. Risk is incredibly important to investors. It's also ephemeral and unmeasurable. All of this makes it very hard to recognize, especially when emotions are running high. But recognize it we must. In the passage that follows, written in July 2007, I take you through the evaluation process we used at Oaktree to gauge the investment environment and the risk mood at the time. In other time periods, the specifics might be different, but I hope this example of the thought process will be useful. I want to point out emphatically that none of the comments in the July 2007 memo, and none of my other warnings, has anything to do with predicting the future. Everything you needed to know in the years leading up to the crash could be discerned through awareness of what was going on in the present. The reality of risk is much less simple and straightforward than the perception. People vastly overestimate their ability to recognize risk and underestimate what it takes to avoid it. Thus, they accept risk unknowingly and in so doing contribute to its creation. That's why it's essential to apply uncommon, second-level thinking to the subject. Risk arises as investor behavior alters the market. Investors bid up assets, accelerating into the present appreciation that otherwise would have occurred in the future, and thus lowering prospective returns. And as their psychology strengthens and they become bolder and less worried, investors cease to demand adequate risk premiums. The ultimate irony lies in the fact that the reward for taking incremental risk shrinks as more people move to take it. Thus, the market is not a static arena in which investors operate. It is responsive, shaped by investors' own behavior. Their increasing confidence creates more that they should worry about, just as their rising fear and risk aversion combine to widen risk premiums at the same time as they reduce risk. I call this the perversity of risk. 7. The most important thing is controlling risk. Outstanding investors, in my opinion, are distinguished at least as much for their ability to control risk as they are for generating return. High absolute return is much more recognizable and titillating than superior risk-adjusted performance. That's why it's high-returning investors who get their pictures in the papers. Since it's hard to gauge risk and risk-adjusted performance, even after the fact, and since the importance of managing risk is widely underappreciated, investors rarely gain recognition for having done a great job in this regard. That's especially true in good times. But in my opinion, great investors are those who take risks that are less than commensurate with the returns they earn. They may produce moderate returns with low risk, or high returns with moderate risk. But achieving high returns with high risk means very little, unless you can do it for many years, in which case that perceived high risk either wasn't really high or was exceptionally well managed. Consider the investors who are recognized for doing a great job, people such as Warren Buffett, Peter Lynch, Bill Miller, and Julian Robertson. In general, their records are remarkable because of their decades of consistency and absence of disasters, not just their high returns. Each may have had a bad year or two, but in general they dealt as well with risk as with return. Whatever few awards are presented for risk control, they're never given out in good times. The reason is that risk is covert, invisible. Risk, the possibility of loss, is not observable. What is observable is loss, and loss generally happens only when risk collides with negative events. This is a very important point, so let me give you a couple of analogies to make sure it's clear. Germs cause illness, but germs themselves are not illness. We might say illness is what results when germs take hold. Homes in California may or may not have construction flaws that would make them collapse during earthquakes. We find out only when earthquakes occur. Likewise, loss is what happens when risk meets adversity. Risk is the potential for loss if things go wrong. As long as things go well, loss does not arise. Risk gives rise to loss only when negative events occur in the environment. We must remember that when the environment is salutary, that is only one of the environments that could have materialized that day or that year. This is Nassim Nicholas Taleb's idea of alternative histories, described in more detail in Chapter 16. The fact that the environment wasn't negative does not mean that it couldn't have been. Thus, the fact that the environment wasn't negative doesn't mean risk control wasn't desirable, even though, as things turned out, it wasn't needed at that time. The important thing here is the realization that risk may have been present even though loss didn't occur. Therefore, the absence of loss does not necessarily mean the portfolio was safely constructed. So, risk control can be present in good times, but it isn't observable because it's not tested. Ergo, there are no awards. Only a skilled and sophisticated observer can look at a portfolio in good times and divine whether it is a low-risk portfolio or a high-risk portfolio. In order for a portfolio to make it through tough times, the risk generally has to be well controlled. If the portfolio thrives in good times, however, we can't tell whether risk control was A. present but not required, or B. lacking. Bottom line, risk control is invisible in good times but still essential, since good times can so easily turn into bad times. Now we come back to the germs that haven't taken hold, or perhaps the earthquakes that haven't happened. A good builder is able to avoid construction flaws, while a poor builder incorporates construction flaws. When there are no earthquakes, you can't tell the difference. Likewise, an excellent investor may be one who, rather than reporting higher returns than others, achieves the same return, but does so with less risk, or even achieves a slightly lower return with far less risk. Of course, when markets are stable or rising, we don't get to find out how much risk a portfolio entailed. That's what's behind Warren Buffett's observation that other than when the tide goes out, we can't tell which swimmers are clothed and which are naked. It's an outstanding accomplishment to achieve the same return as the risk bearers and do so with less risk. But most of the time, it's a subtle, hidden accomplishment that can be appreciated only through sophisticated judgments. Since usually there are more good years in the markets than bad years, and since it takes bad years for the value of risk control to become evident in reduced losses, the cost of risk control, in the form of return foregone, can seem excessive. In good years in the market, risk-conscious investors must content themselves with the knowledge that they benefited from its presence in the portfolio, even though it wasn't needed. They're like the prudent homeowners who carry insurance and feel good about having protection in place, even when there's no fire. Controlling the risk in your portfolio is a very important and worthwhile pursuit. The fruits, however, come only in the form of losses that don't happen. Such what, if calculations are difficult in placid times? While risk control is essential, risk-bearing is neither wise nor unwise per se. It's inevitably part of most investment strategies and investment niches. It can be done well or poorly, and at the right time or the wrong time. If you have enough skill to be able to move into the more aggressive niches with risk under control, it's the best thing possible. But the potential pitfalls are many, and they must be avoided. Careful risk controllers know they don't know the future. They know it can include some negative outcomes, but not how bad they might be, or exactly what their probabilities are. Thus, the principal pitfalls come in the inability to know how bad is bad, and in resulting poor decisions. Especially in view of the vagaries presented previously in this chapter, I want to make clear the important distinction between risk control and risk avoidance. Risk control is the best route to loss avoidance. Risk avoidance, on the other hand, is likely to lead to return avoidance as well. Once in a while, I hear someone talk about Oaktree's desire to avoid investment risk, and I take great issue. The road to long-term investment success runs through risk control more than through aggressiveness. Over a full career, most investors' results will be determined more by how many losers they have and how bad they are than by the greatness of their winners. Skillful risk control is the mark of the superior investor. Chinese letter, 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 tilde. Chinese letter, 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 Chinese letter. Chinese letter, Chinese letter, Chinese letter, Chinese letter, Chinese letter, Chinese letter, Chinese letter. Chinese letter, Chinese letter, Chinese letter, Chinese letter. Chinese letter, Chinese letter, Chinese letter, Chinese letter, Chinese letter, Chinese letter. https://www.chengen5.com. Chinese letter, Chinese letter, Chinese letter, Chinese letter, Chinese letter, Chinese letter, Chinese letter. Chinese letter, 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 Chinese letter. Chinese letter, Chinese letter, Chinese letter, Chinese letter, Chinese letter, Chinese letter. 8. Yes. The most important thing is being attentive to cycles. Yes, yes, yes. The more time I spend in the world of investing, the more I appreciate the underlying cyclicality of things. In November 2001, I devoted an entire memo to the subject. I titled it, "You Can't Predict. You Can Prepare," borrowing the advertising tagline of MassMutual Life Insurance Company, because I agree wholeheartedly with their theme. We never know what lies ahead, but we can prepare for the possibilities and reduce their sting. In investing, as in life, there are very few sure things. Values can evaporate, estimates can be wrong, circumstances can change, and sure things can fail. However, there are two concepts we can hold to with confidence. Very few things move in a straight line. There's progress, and then there's deterioration. Things go well for a while, and then poorly. Progress may be swift and then slow down. Deterioration may creep up gradually, and then turn climactic. But the underlying principle is that things will wax and wane, grow and decline. The same is true for economies, markets, and companies. They rise and fall. The basic reason for the cyclicality in our world is the involvement of humans. Mechanical things can go in a straight line. Time moves ahead continuously. So can a machine when it's adequately powered. But processes in fields like history and economics involve people, and when people are involved, the results are variable and cyclical. The main reason for this, I think, is that people are emotional and inconsistent, not steady and clinical. Objective factors do play a large part in cycles, of course. Factors such as quantitative relationships, world events, environmental changes, technological developments, and corporate decisions. But it's the application of psychology to these things that causes investors to overreact or underreact, and thus determines the amplitude of the cyclical fluctuations. When people feel good about the way things are going and optimistic about the future, their behavior is strongly impacted. They spend more and save less. They borrow to increase their enjoyment or their profit potential, even though doing so makes their financial position more precarious, of course. Concepts like precariousness are forgotten in optimistic times, and they become willing to pay more for current value or a piece of the future. All of these things are capable of reversing in a second. One of my favorite cartoons features a TV commentator saying, "Everything that was good for the market yesterday is no good for it today." The extremes of cycles result largely from people's emotions and foibles, non-objectivity and inconsistency. Yes. The credit cycle deserves a very special mention for its inevitability, extreme volatility, and ability to create opportunities for investors attuned to it. Of all the cycles, it's my favorite. Yes. Yes. Please note that this memo, written almost 10 years ago, perfectly describes the process through which the 2007-2008 financial crisis arose. It wasn't predictive ability that enabled me to write it, just familiarity with a never-ending underlying cycle. Cycles will never stop occurring. If there were such a thing as a completely efficient market, and if people really made decisions in a calculating and unemotional manner, perhaps cycles, or at least their extremes, would be banished. But that'll never be the case. Economies will wax and wane as consumers spend more or less, responding emotionally to economic factors or exogenous events, geopolitical or naturally occurring. Companies will anticipate a rosy future during the upcycle, and thus overexpand facilities and inventories. These will become burdensome when the economy turns down. Providers of capital will be too generous when the economy's doing well, abetting overexpansion with cheap money, and then they'll pull the reins too tight when things cease to look as good. Investors will overvalue companies when they're doing well and undervalue them when things get difficult. And yet, every decade or so, people decide cyclicality is over. They think either the good times will roll on without end, or the negative trends can't be arrested. At such times, they talk about virtuous cycles or vicious cycles, self-feeding developments that will go on forever in one direction or the other. Case in point, on November 15, 1996, the Wall Street Journal reported on a growing consensus. From boardrooms to living rooms and from government offices to trading floors, a new consensus is emerging. The big, bad business cycle has been tamed. Does anyone remember a steady, non-cyclical economic environment in the years since then? What would explain the emerging crisis of 1998, the recession of 2002, and the financial crisis, and worst recession since World War II, of 2008? This belief that cyclicality has been ended exemplifies a way of thinking based on the dangerous premise that this time it's different. These four words should strike fear, and perhaps suggest an opportunity for profit, for anyone who understands the past and knows it repeats. Thus, it's essential that you be able to recognize this form of error when it arises. One of my favorite books is a little volume titled Oh Yeah, a 1932 compilation of pre-depression wisdom from businessmen and political leaders. It seems that even then, pundits were predicting a cycle-free economy. Nyeh, nyeh, nyeh. Ignoring cycles and extrapolating trends is one of the most dangerous things an investor can do. People often act as if companies that are doing well will do well forever, and investments that are outperforming will outperform forever, and vice versa. Instead, it's the opposite that's more likely to be true. The first time rookie investors see this phenomenon occur, it's understandable that they might accept that something that's never happened before, the cessation of cycles, could happen. But the second time or the third time, those investors, now experienced, should realize it's never going to happen and turn that realization to their advantage. The next time you're approached with a deal predicated on cycles having ceased to occur, remember that invariably that's a losing bet. 9. The most important thing is awareness of the pendulum. The second investor memo I ever wrote, back in 1991, was devoted almost entirely to a subject that I have come to think about more and more over the years: the pendulum-like oscillation of investor attitudes and behavior. 13 years later, I revisited the subject of the pendulum at length in another memo. In it I observed that in addition to the elements mentioned earlier, the pendulum also swings with regard to greed versus fear, willingness to view things through an optimistic or a pessimistic lens, faith in developments that are on the come, credulousness versus skepticism, and risk tolerance versus risk aversion. The swing in the last of these, attitudes toward risk, is a common thread that runs through many of the market's fluctuations. Risk aversion is the essential ingredient in a rational market, as I said before, and the position of the pendulum with regard to it is particularly important. Improper amounts of risk aversion are key contributors to the market excesses of bubble and crash. It's an oversimplification, but not a grievous one, to say the inevitable hallmark of bubbles is a dearth of risk aversion. In crashes, on the other hand, investors fear too much. Excessive risk aversion keeps them from buying even when no optimism, only pessimism, is embodied in prices and valuations are absurdly low. The pendulum swing regarding attitudes toward risk is one of the most powerful of all. In fact, I've recently boiled down the main risks in investing to two: the risk of losing money and the risk of missing opportunity. It's possible to largely eliminate either one, but not both. In an ideal world, investors would balance these two concerns. But from time to time, at the extremes of the pendulum swing, one or the other predominates. For example, thus, the last several years have provided an unusually clear opportunity to witness the swing of the pendulum, and how consistently most people do the wrong thing at the wrong time. When things are going well and prices are high, investors rush to buy, forgetting all prudence. Then, when there's chaos all around and assets are on the bargain counter, they lose all willingness to bear risk and rush to sell. And it will ever be so. Very early in my career, a veteran investor told me about the 3 stages of a bull market. Now I'll share them with you. Why would anyone waste time trying for a better description? This one says it all. It's essential that we grasp its significance. 35 years after I first learned about the stages of a bull market, after the weaknesses of subprime mortgages and their holders had been exposed, and as people were worrying about contagion to a global crisis, I came up with the flip side, the 3 stages of a bear market. Just 6 months after those words were written, the progression had gone all the way to the 3rd stage. A full meltdown of the world financial system was considered possible. In fact, the first steps, the bankruptcy of Lehman Brothers and the absorption or rescue of Bear Stearns, Merrill Lynch, AIG, Fannie Mae, Freddie Mac, Wachovia and WAMU, had taken place. Since this was the biggest crisis ever, investors bought into the 3rd stage, during which everyone's convinced things can only get worse, more than ever before. Thus, in many asset classes, the things determined by the pendulum's swing, the price declines in 2008, the resultant investment opportunities at the nadir, and the gains in 2009 were the greatest I've ever seen. The significance of all this is the opportunity it offers to those who recognize what is happening and see the implications. At one extreme of the pendulum, the darkest of times, it takes analytical ability, objectivity, resolve, even imagination to think things will ever get better. The few people who possess those qualities can make unusual profits with low risk. But at the other extreme, when everyone assumes and prices in the impossible, improvement forever, the stage is set for painful losses. It all goes together. None of these is an isolated event or a chance occurrence. Rather, they're all elements in a recurring pattern that can be understood and profited from. The oscillation of the investor pendulum is very similar in nature to the up and down fluctuation of economic and market cycles described in Chapter 8. For some reason, I find myself making a distinction between the two and speaking of them in different terms, but they're both highly important, and the key lessons are the same. With the benefit of almost 20 years, experience since writing that first memo about the pendulum in 1991, I'll rephrase its key observations. The occurrence of this pendulum-like pattern in most market phenomena is extremely dependable. But just like the oscillation of cycles, we never know. There are a few things of which we can be sure, and this is one: extreme market behavior will reverse. Those who believe that the pendulum will move in one direction forever, or reside at an extreme forever, eventually will lose huge sums. Those who understand the pendulum's behavior can benefit enormously. 10. The most important thing is combating negative influences. Inefficiencies, mispricings, misperceptions, mistakes that other people make provide potential opportunities for superior performance. Exploiting them is, in fact, the only road to consistent outperformance. To distinguish yourself from the others, you need to be on the right side of those mistakes. Why do mistakes occur? Because investing is an action undertaken by human beings, most of whom are at the mercy of their psyches and emotions. Many people possess the intellect needed to analyze data, but far fewer are able to look more deeply into things and withstand the powerful influence of psychology. To say this another way, many people will reach similar cognitive conclusions from their analysis, but what they do with those conclusions varies all over the lot because psychology influences them differently. The biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. Investor psychology includes many separate elements, which we will look at in this chapter, but the key thing to remember is that they consistently lead to incorrect decisions. Much of this falls under the heading of human nature. The first emotion that serves to undermine investors' efforts is the desire for money, especially as it morphs into greed. Most people invest to make money. Some participate as an intellectual exercise or because it's a good field in which to vent their competitiveness, but even they keep score in terms of money. Money may not be everyone's goal for its own sake, but it is everyone's unit of account. People who don't care about money generally don't go into investing. There's nothing wrong with trying to make money. Indeed, the desire for gain is one of the most important elements in the workings of the market and the overall economy. The danger comes when it moves on further to greed, which Merriam-Webster's defines as an inordinate or all-consuming and usually reprehensible acquisitiveness, especially for wealth or gain. Greed is an extremely powerful force. It's strong enough to overcome common sense, risk aversion, prudence, caution, logic, memory of painful past lessons, resolve, trepidation, and all the other elements that might otherwise keep investors out of trouble. Instead, from time to time, greed drives investors to throw in their lot with the crowd in pursuit of profit, and eventually they pay the price. The counterpart of greed is fear, the second psychological factor we must consider. In the investment world, the term doesn't mean logical, sensible risk aversion. Rather, fear like greed connotes excess. Fear then is more like panic. Fear is overdone concern that prevents investors from taking constructive action when they should. Many times over the course of my career, I've been amazed by how easy it is for people to engage in willing suspension of disbelief. Thus, the third factor I want to discuss is people's tendency to dismiss logic, history, and time-honored norms. This tendency makes people accept unlikely propositions that have the potential to make them rich. If only they held water. Charlie Munger gave me a great quotation on this subject from Demosthenes. Nothing is easier than self-deceit. For what each man wishes, that he also believes to be true. The belief that some fundamental limiter is no longer valid, and thus historic notions of fair value no longer matter, is invariably at the core of every bubble and consequent crash. What makes investors fall for these delusions? The answer often lies in the ease with which, often in service to greed, they dismiss or ignore the lessons of the past. Extreme brevity of the financial memory, to use John Kenneth Galbraith's wonderful phrase, keeps market participants from recognizing the recurring nature of these patterns, and thus their inevitability. The infallible investment that people come to believe can produce high returns without risk, the sure thing or free lunch, is well worth further discussion. What makes for belief in silver bullets? First, there's usually a germ of truth. It's spun into an intelligent-sounding theory, and adherents get on their soapboxes to convince others. Then it produces profits for a while, whether because there's merit in it, or just because buying on the part of new converts lifts the price of the subject asset. Eventually, the appearance that, there's a path to sure wealth and its working turns it into a mania. As Warren Buffett told Congress on June 2, 2010, rising prices are a narcotic that affects the reasoning power up and down the line. But after the fact, after it has popped, A mania is called a bubble. The fourth psychological contributor to investor error is the tendency to conform to the view of the herd rather than resist, even when the herd's view is clearly cockeyed. In How Markets Fail, John Cassidy describes classic psychology experiments conducted by Swarthmore, Solomon Asch in the 1950s. Asch asked groups of subjects to make judgments about visual exhibits, but all but one of the subjects in each group were shills working for him. The shills intentionally said the wrong thing, with dramatic impact on the one real subject. Cassidy explains, this setup placed the genuine subject in an awkward spot. As Asch put it, upon him we have brought to bear two opposed forces, the evidence of his senses and the unanimous opinion of a group of his peers. A high percentage of the real subjects ignored what they saw and sided with the other group members, even though they were obviously in the wrong. This indicates the influence of the crowd, and thus suggests reservations about the validity of consensus decisions. Like the participants in Solomon Asch's visual experiments in the 1950s, Cassidy writes, many people who don't share the consensus view of the market start to feel left out. Eventually, it reaches a stage where it appears the really crazy people are those not in the market. Time and time again, the combination of pressure to conform and the desire to get rich causes people to drop their independence and skepticism, overcome their innate risk aversion, and believe things that don't make sense. It happens so regularly that there must be something dependable at work, not a random influence. The fifth psychological influence is envy. However negative the force of greed might be, always spurring people to strive for more and more, the impact is even stronger when they compare themselves to others. This is one of the most harmful aspects of what we call human nature. People who might be perfectly happy with their lot in isolation become miserable when they see others do better. In the world of investing, most people find it terribly hard to sit by and watch while others make more money than they do. I know of a nonprofit institution whose endowment earned 16% a year from June 1994 to June 1999, but since its peers averaged 23%, the people involved with the endowment were dejected. Without growth stocks, technology stocks, buyouts, and venture capital, the endowment was entirely out of step for half a decade. But then the tech stocks collapsed, and from June 2000 to June 2003, the institution earned 3% a year while most endowments suffered losses. The stakeholders were thrilled. There's something wrong with this picture. How can people be unhappy making 16% a year and happy making 3%? The answer lies in the tendency to compare ourselves to others and the deleterious impact this can have on what should be a constructive, analytical process. The sixth key influence is ego. It can be enormously challenging to remain objective and calculating in the face of facts like these. In contrast, thoughtful investors can toil in obscurity, achieving solid gains in the good years and losing less than others in the bad. They avoid sharing in the riskiest behavior because they're so aware of how much they don't know, and because they have their egos in check. This, in my opinion, is the greatest formula for long-term wealth creation, but it doesn't provide much ego gratification in the short run. It's just not that glamorous to follow a path that emphasizes humility, prudence, and risk control. Of course, investing shouldn't be about glamour, but often it is. Finally, I want to mention a phenomenon I call capitulation, a regular feature of investor behavior late in cycles. Investors hold to their convictions as long as they can, but when the economic and psychological pressures become irresistible, they surrender and jump on the bandwagon. In general, people who go into the investment business are intelligent, educated, informed, and numerate. They master the nuances of business and economics and understand complex theories. Many are able to reach reasonable conclusions about value and prospects. But then psychology and crowd influences move in. Much of the time, assets are overpriced and appreciating further, or underpriced and still cheapening. Eventually, these trends have a corrosive effect on investors' psyches, conviction, and resolve. The stocks you rejected are making money for others. The ones you chose to buy are lower every day, and concepts you dismissed as unsafe or unwise. Hot new issues, high-priced tech stocks without earnings, highly levered mortgage derivatives, are described daily as delivering for others. As an overpriced stock goes even higher or an underpriced stock continues to cheapen, it should get easier to do the right thing. Sell the former and buy the latter. But it doesn't. The tendency toward self-doubt combines with news of other people's successes to form a powerful force that makes investors do the wrong thing, and it gains additional strength as these trends go on longer. It's one more influence that must be fought. The desire for more, the fear of missing out, the tendency to compare against others, the influence of the crowd, and the dream of the sure thing. These factors are near universal. Thus, they have a profound collective impact on most investors and most markets. This is especially true at the market extremes. The result is mistakes, frequent, widespread, recurring, expensive mistakes. Does all this strike you as just so much theorizing, something that couldn't possibly apply to you? I sincerely hope you're right. But just in case you doubt that rational people could succumb to the damaging forces of emotion, let me remind you of two little words: tech bubble. Earlier, I mentioned that crazy time as evidence of what happens when investors disregard the need for a reasonable relationship between value and price. What is it that causes them to abandon common sense? Some of the same emotions we have been talking about here: greed, fear, envy, self-deceit, ego. Let's review the scenario and watch psychology at work. The 1990s were a very strong period for stocks. There were bad days and months, of course, and traumas such as a big jump in interest rates in 1994. But Standard & Poor's 500 stock index showed a gain every year from 1991 through 1999 inclusive, and its return averaged 20.8% per year. Those results were enough to put investors in an optimistic mood and render them receptive to bullish stories. Growth stocks performed a bit better than value stocks in the early part of the decade, perhaps as a rebound from value's outperformance in the 1980s. This, too, increased investors' willingness to highly value companies' growth potential. Investors became enthralled by technological innovation. Developments such as broadband, the internet, and e-commerce seemed likely to change the world, and tech and telecom entrepreneurs were lionized. Tech stocks appreciated, attracting more buying, and this led to further appreciation, in a process that as usual took on the appearance of an unstoppable virtuous circle. Logical seeming rationales play a part in most bull markets, and this one was no different. Tech stocks will outperform all other stocks because of the company's excellence. More tech names will be added to the equity indices, reflecting their growing importance in the economy. This will require index funds and the closet indexers, who covertly emulate indices to buy more of them, and active investors will buy to keep up as well. More people will create 401(k) retirement plans, and 401(k) investors will increase the representation of stocks in their portfolios and the allocation to tech stocks among their stocks. For these reasons, tech stocks, A, must keep appreciating, and B, must outpace other stocks. Thus, they'll attract still more buying. The fact that all of these phenomena actually occurred for a while lent credence to this theory. Initial public offerings of technology stocks began to appreciate by tens and even hundreds of percent on the day of issue, and took on the appearance of sure winners. Gaining access to IPOs became a popular mania. From the perspective of psychology, what was happening with IPOs is particularly fascinating. It went something like this. The guy next to you in the office tells you about an IPO he's buying. You ask what the company does. He says he doesn't know, but his broker told him it's going to double on the day of issue. So you say that's ridiculous. A week later, he tells you it didn't double. It tripled, and he still doesn't know what it does. After a few more of these, it gets hard to resist. You know it doesn't make sense, but you want protection against continuing to feel like an idiot. So, in a prime example of capitulation, you put in for a few hundred shares of the next IPO. And the bonfire grows still higher on the buying from new converts like you. Venture capital funds that had invested in successful startup companies attracted great attention and a great deal of capital. In the year Google went public, the fund that had seeded it appreciated 350% on the basis of that one success. Tech stock investors were lauded by the media for their brilliance. The ones least restrained by experience and skepticism, and thus making the most money, were often in their 30s, even their 20s. Never was it pointed out that they might be beneficiaries of an irrational market, rather than incredible astuteness. Remember my earlier comment that all bubbles start with a modicum of truth. The seed of truth for the scenario just described lay in technology's very real potential. The fertilizer came from the attendant bullish rationales, and the supercharging came from the price appreciation that was taking place and looked unstoppable. Soon after the January 2000 memo was written, the tech stocks began to collapse of their own weight, even in the absence of any single event that would cause them to do so. All of a sudden it became clear that stock prices had gone too far and should correct. When an investment fad goes bad, the Wall Street Journal usually runs a table showing the resulting losses, with representative stocks down 90% or more. When the tech bubble burst, however, the table showed losses exceeding 99%. The broad stock indices experienced their first 3-year decline since the Great Depression, and tech stocks, and stocks in general, no longer looked like anything special. When we look back over the intervening decade, we see that the vaunted technological developments did change the world. The winning companies are hugely valuable, and things like newspapers and CDs have been profoundly affected. But it's equally obvious that investors allowed their common sense to be overridden in the bubble. They ignored the fact that not all the companies could win, that there would be a lengthy shakeout period, that profitability wouldn't come easily from providing services gratis, and that shares in money-losing companies valued at high multiples of sales, since there were no earnings, carried great danger. Greed, excitement, illogicality, suspension of disbelief and ignoring value cost people a lot of money in the tech bubble. And by the way, a lot of brilliant, disciplined value investors looked dumb in the months and years before the bubble burst, which of course it eventually did. To avoid losing money in bubbles, the key lies in refusing to join in when greed and human error cause positives to be wildly overrated and negatives to be ignored. Doing these things isn't easy, and thus few people are able to abstain. In just the same way, it's essential that investors avoid selling, and preferably should buy, when fear becomes excessive in a crash. That reminds me to point out that bubbles are capable of arising on their own and need not be preceded by crashes, whereas crashes are invariably preceded by bubbles. As hard as it was for most people to resist buying in the tech bubble, it was even harder to resist selling, and still more difficult to buy, in the depths of the credit crisis. At worst, failing to buy in a bull market means you may look like a laggard and experience opportunity costs. But in the crash of 2008, the downside of failing to sell appeared to be unlimited loss. Armageddon actually seemed possible. What, in the end, are investors to do about these psychological urges that push them toward doing foolish things? Learn to see them for what they are. That's the first step toward gaining the courage to resist. And be realistic. Investors who believe they're immune to the forces described in this chapter do so at their own peril. If they influence others enough to move whole markets, why shouldn't they affect you too? If a bull case is so powerful that it can make adults overlook elevated valuations and deny the impossibility of the perpetual motion machine, why shouldn't it have the same influence on you? If a scare story of unlimited loss is strong enough to make others sell at giveaway prices, what would keep it from doing the same to you? Believe me, it's hard to resist buying at the top and harder still to sell. When everyone else is buying, the pundits are positive. The rationale is widely accepted. Prices are soaring and the biggest risk takers are reporting huge returns. It's also hard to resist selling and very tough to buy. When the opposite is true at the bottom and holding or buying appears to entail the risk of total loss. Like so many other things described in this book, there's no simple solution, no formula that will tell you when the market has gone to an irrational extreme, no foolproof tool that will keep you on the right side of these decisions, no magic pill that will protect you against destructive emotions. As Charlie Munger says, it's not supposed to be easy. What weapons might you marshal on your side to increase your odds? Here are the ones that work for Oaktree. These things aren't sure to do the job, but they can give you a fighting chance. 11. The most important thing is contrarianism. There's only one way to describe most investors: trend followers. Superior investors are the exact opposite. Superior investing, as I hope I've convinced you by now, requires second-level thinking, a way of thinking that's different from that of others, more complex and more insightful. By definition, most of the crowd can't share it. Thus, the judgments of the crowd can't hold the key to success. Rather, the trend, the consensus view, is something to game against, and the consensus portfolio is one to diverge from. As the pendulum swings or the market goes through its cycles, the key to ultimate success lies in doing the opposite. This is the core of Warren Buffett's oft-quoted advice. The less prudence with which others conduct their affairs, the greater the prudence with which we should conduct our own affairs. He is urging us to do the opposite of what others do, to be contrarians. The logic of crowd error is clear and almost mathematical. Accepting the broad concept of contrarianism is one thing, putting it into practice is another. On one hand, we never know how far the pendulum will swing, when it will reverse, and how far it will then go in the opposite direction. On the other hand, we can be sure that, once it reaches an extreme position, the market eventually will swing back toward the midpoint, or beyond. Investors who believe that the pendulum would move in one direction forever, or having reached an extreme, would stay there, are inevitably disappointed. On the third hand, however, because of the variability of the many factors that influence markets, no tool, not even contrarianism, can be relied on completely. David Swensen heads the Yale University Endowment. Yale's investment performance has been outstanding, and Swensen has had a greater impact on endowment investing than anyone else over the last 2 decades. His thinking, which was highly unusual when Yale began to implement it in the 1980s, came to represent endowment canon. He has a beautiful way of describing the difficulties associated with contrarianism. The ultimately most profitable investment actions are by definition contrarian. You're buying when everyone else is selling, and the price is thus low, or you're selling when everyone else is buying, and the price is high. These actions are lonely and, as Swensen says, uncomfortable. How can we know it's the opposite, The consensus action, that's the comfortable one. Because most people are doing it. Yep, yep. The global credit crisis of 2007-2008 represents the greatest crash I have ever seen. The lessons to be learned from this experience are many, which is one reason I discuss aspects of it in more than one chapter. For me, one such lesson consisted of reaching a new understanding of the skepticism required for contrarian thinking. I'm not usually given to epiphanies, but I had one on the subject of skepticism. Every time a bubble bursts, a bull market collapses,